Hi everyone, welcome to the third video in lesson 3 of our blockchain training unit. Today we'll be continuing with our discussion on cryptocurrency as well as looking at blockchain elsewhere. Under the first broad topic, we'll be looking at altcoins and altcoin season as well as delving a little bit into crypto trading. Now first off, let's look at altcoins. You might be wondering what are altcoins and what defines them as such. Well, Bitcoin was the original cryptocurrency at the point when it started in 2009, and it dominated the field so much that other rivals were defined in relation to this original cryptocurrency. Everything else can therefore be considered an altcoin, and some notable examples are Ethereum, Tether, Ripple, or Cardano. You can visit coinmarketcap.com to take a look at the top cryptocurrencies at the moment. Some of the more obscure altcoins don't directly have fiat pairings, for instance, BTC USD. But in this case, for other altcoins, you might need to buy Bitcoin or Ethereum first in order to exchange with these altcoins. Now that you guys have gone through lessons on Bitcoin and Ethereum, you should have a pretty good understanding of what a cryptocurrency actually is. In fact, each cryptocurrency has its own uses that it's built for. One of the most famous altcoins is Tether, or USDT. It's widely considered a blockchain-based stablecoin. Keep in mind that Tether might not be considered a stablecoin to some people, as we will explore later when we look at some of its current criticisms. Its objective is to actually keep crypto valuations stable by offering a coin that can be used as a stable and reliable store of value. 1 USDT roughly equals to 1 USD, and hence it saves the need for a transfer to your fiat exchange and paying the exchange for converting the crypto you are holding into USD, because you can simply use USDT on other crypto exchanges to buy various cryptocurrencies. However, there have been allegations on whether the actual USD reserves of USDT are proven, and they revealed that the cryptocurrency is actually only 2.9% backed by cash reserves, with the rest being in derivatives such as cash equivalents or secured loans. Sadly, Peter has also encountered troubles with the New York Attorney General Office for unlawfully hiding losses. Another altcoin that must be known is Ripple. Ripple's main value proposition is its focus on being the fastest and most secure payment option. By using its own consensus mechanism, the Ripple Protocol Consensus Algorithm, it is considered to be one of the most centralized cryptocurrencies due to the recommendation of a unique node list to trust, which is actually a list of validators that the participant believes are trustable and will not defraud them. As you can see from the photo here, this is how it works, where fiat currencies are first converted to XRP, which is then converted via a digital asset exchange to the corresponding cryptocurrency that is wanted. Ripple actually launched its first on-demand liquidity service in Japan by partnering with the largest money transfer provider in Japan, SBI Remit, and one of the leading mobile wallet services in the Philippines, Coins.ph. This partnership actually allows them to achieve faster and more affordable cross-border payments from Japan to the Philippines, and customers can leverage the digital asset XRP to eliminate wallet pre-funding and other operational costs. Stablecoins are also known as cryptocurrencies that are pegged to other assets or money-like assets. These can vary from traditional fiat currencies such as USDT, as we explored with Tether just now, or other digital assets. The majority of the dozens of stablecoins that currently exist actually use the dollar as their benchmark asset, but can be pegged to other fiat currencies issued by governments such as the euro and the yen. As a result, the price of stablecoins fluctuates very little, unlike high-profile cryptocurrencies like Bitcoin and Ethereum that are prone to sudden ups and downs. One key example we discussed above, which was USDT, was the first stablecoin that was created in 2014. And as of July 2021, USDT comprised just over half of the market capitalization of all stablecoins available worldwide. Some of the uses of stablecoins would include popular usage in DeFi projects such as yield farming and lending. for instance, USD coin. Another key use is for storage and conversion due to its stability, where stable coins are theoretically able to be converted into fiat currencies at a constant exchange rate because they can maintain their value. Originally, stablecoins were also primarily used to buy other cryptocurrencies such as Bitcoin, because many cryptocurrency exchanges didn't have access to traditional banking. They are therefore more useful than country-issued currencies because you can use them 24 hours a day, 7 days a week, and anywhere in the world, all without relying on banks. These money transfers take seconds to complete. However, altcoins are definitely not without their criticisms. Left unregulated, most issuers of altcoins or stablecoins actually follow a business model similar to these prime money market mutual funds that destabilized the financial system during the 2008 financial crisis. Also known as too big to fail banks, these institutions implicitly promise their holders a stable price and backing of their securities without deposit insurance. This is very similar to what several stablecoins do, where a stable price is promised with daily redemptions, but there is no capital or deposit assurance to back this implicit guarantee. These stablecoin issuers actually profit by investing customer funds in assets that are exposed to market and credit risk, such as bonds, metals, funds, and even other tokens. As we discussed with the example of USDT, they only held 2.9% of their holdings in cash reserves. If these other risky assets fall in value, stablecoin issuers may not even have enough capital to allow their holders to convert their deposits back to the dollar at a 1:1 rate. This could cause loss of investor confidence because the stablecoin's value could drop below $1, and this is another severe criticism that many critics have raised. We'll now go on to discuss meme coins briefly. So meme coins, as I'm sure many of you will be familiar with, are actually cryptocurrencies that are created based on memes or jokes. Some of the most prominent ones would be Dogecoin, Shiba Inu, Baby Dogecoin, or even HODL coin. So many of these meme coins saw a meteoric rise at the start of the year, and they were well received as a joke, even by big players in the crypto field who actually came forth to back these cryptocurrencies. They have gained huge popularity in a short amount of time and can be a result of influencers or even retail investors. However, similar to altcoins, there are more than 5,000 meme coins in existence, which you could explore by going on CoinMarketCap. Another key feature of meme coins is that they aren't created to address real-world problems. Some of the real-world issues that actual cryptocurrencies aim to address would be decentralized currencies or even changing up the payment industries. However, meme coins serve no real-world purpose and were created for the purpose of a quick monetary gain or just to make a joke embodied into a coin itself. As we discussed with Dogecoin, some of the key events that actually took place relating to Elon Musk, if you've been following the news recently, is that Elon Musk has actually announced that his company SpaceX will be launching a satellite funded by Dogecoin. And for those of you who are familiar with the meme, we will literally be taking Dogecoin to the moon. Let's now go on to discuss altcoin season, what it is, and what it implies for holders of cryptocurrency. So some of you may have heard of the term altcoin season, but let's actually explore what it means to be in an altcoin season. So during altcoin season, Bitcoin, the major cryptocurrency, tends to lose some of its dominance in the market to altcoins. In terms of market capitalization, Bitcoin actually has just under half of the circulating supply of market capitalization of all cryptocurrencies, but this fluctuates on a daily basis, as I'm sure everybody would be aware of. During altcoin season, this would be a prolonged period where the market cap of Bitcoin decreases slightly compared to the overall market cap of other crypto assets, and we can see other altcoins taking the rise in terms of price and market cap. So how do you know when it's altcoin season? There are actually several indicators or indexes that attempt to determine the beginning and end of altcoin season using relative percentages of price, market cap, trading volumes, volatility, and all these other concepts. However, they aren't actually very objective. So when looking at indicators like these, it's a good idea to make sure that you are aware of what these indicators are tracking and that you know exactly what you're doing by utilizing these indicators so that you can understand the different movements in terms of the price and the market cap and the volume. So why does altcoin season happen? So altcoin season tends to happen, well, based on historical returns after a Bitcoin bull run or signs of a bull run, because this can cause investors to sell off some of the Bitcoin that they are holding in order to realize gains. And this naturally causes the Bitcoin price to tumble slightly. They then use these profits to purchase altcoins, causing prices to be driven up. So it's essentially just a reallocation of market capitalization from Bitcoin to other various altcoins based on the sentiments in the market. Altcoin season can also be caused by hype around individual cryptocurrencies, as per what happened earlier in 2021, with the Dogecoin hype that was fueled by several high-profile backers, including Elon Musk. So these are some of the factors that can contribute to altcoin season taking place. So I'm sure at this point in time, some of you are interested in how crypto trading works and how you might be able to get started in trying this out. For those of you who are unsure, we'll be covering some of the fundamentals of crypto trading in this set of slides as well. So do tune in if you are interested in seeing how you might be able to get started on crypto trading. So let's first cover some of the extreme basics. So what is trading? Trading itself refers to the act of buying and selling financial instruments to hopefully make a profit. So in a similar sense to other securities, for instance, bonds or stocks or other derivatives, cryptocurrencies are something that can be traded and they're actually increasing in popularity. So in the process of trading, you actively enter and exit positions over a relatively short time frame with a focus on speculation, momentum, volumes, and volatility, and looking at how all these various factors drive the prices. So one key distinction that you must know is that trading is not the same as investing, whereas investing has a longer time horizon with a focus on fundamentals. So for instance, if you are looking at investing into a company, you wouldn't really look at the volatility and the speculation around the company. You would look at something more concrete, something more fundamental, such as the company financials, expected performance over the next 1 to 2 years. Whereas trading functions very differently. So as you'll learn later, it's more focused on looking at these other short-term factors that can influence price movements. So the two types of positions that you can initiate when you are trading are long and short. So when you long an instrument, you would expect prices to increase and you are essentially bullish about that instrument. You are buying it with the hopes of selling it at a higher price later on. When you short something, it's the exact opposite of going long, and you are actually anticipating that the instrument will fall in price, so you're bearish on that particular instrument. Shorting is a little bit more complicated than long because you actually have to borrow the asset or the security and you sell it back at the current price, and there's a whole system of financial intermediaries that are involved in the process of shorting because you have to find an institution or an entity that actually owns that asset before you can borrow it from them and then sell it in the market. So it gets a little bit complicated once you discuss the short interest rates and things like that. But essentially what you need to know is that when you short an instrument, you are bearish on that. So some background on the crypto market before we begin proper. The cryptocurrency market is actually available to trade 24 hours a day, 7 days a week, because there's no centralized governance of the market. So for those of you who might be familiar with Forex, it's actually a very similar market because it's open all day, every day, without having any of the trading holidays that, for instance, the New York Stock Exchange or the Nasdaq might have. So cryptocurrency transactions take place directly between individuals on cryptocurrency exchanges all over the world. Another notable point is that the crypto market is actually highly volatile. So The volatility of cryptocurrencies is part of what makes this market so exciting, which actually is founded on rapid intraday price movements. And these can provide a range of opportunities for traders to go long or go short, but they also come with extremely high risk levels. For instance, between October 2017 and October 2018, over the period of a year, the price of Bitcoin actually rose as high as 19,000 and fell to lows of 5,000. So for those of you who are actively following Bitcoin prices, you would also know that it's at a period of highly increased volatility. So this is definitely something that we should all be aware of before we get into the market. So we'll start off with looking at the different styles of trading, as well as their time frames and what you actually do when executing that trade. So the first type that we'll look at is scalping, which is the most short-term form of trading, where scalp traders hold positions open for seconds to minutes at the very most. So these short-lived trades target very small intraday price fluctuations, and the purpose is to make a series of quick trades with smaller profit gains, but let the profits accumulate throughout the day due to the sheer number of trades being executed in each trading session. So this style of trading requires a very tight spread, which means that ideally you would have a small difference between the buying price and the selling price, or for those of you who are familiar with the terms, the bid and ask of the market. So this actually ensures that you don't get the profits eaten up too much by the spread between those two prices when you're buying and selling. The second type of trading that exists is day trading. So for those of you who are not really comfortable with the intensity and volatility of scalp trading, but you still don't want to hold positions overnight, day trading may be the best alternative for that. So day traders enter and exit their positions on the same day, which varies slightly from swing and position traders, as we'll discuss after this. And this removes the risk of any large overnight moves, which can actually happen. So at the end of the day, these traders close their position with either a profit or a loss. And these trades are usually held for a period of minutes up to hours. And as a result, they require sufficient time to analyze the markets and frequently monitor positions throughout the day. Just like scalp traders, day traders rely on frequent small gains in order to build up their profits. The third type of trading that we'll discuss today is swing trading. So unlike day traders who hold positions for less than a day, swing traders typically hold positions for several days, although it can stretch as long as several weeks in certain cases. Because positions are held over a period of time, to capture short-term market moves, traders do not actually need to sit and constantly monitor the charts and their trades throughout the day. So this makes it a very popular trading style for those who have other commitments, such as a full-time job, and would like to just trade in their leisure time without having to sacrifice time at work or their sleep. However, it's still necessary for swing traders to dedicate several hours a day in order to analyze the markets. So finally, we have position trading. So position traders are focused on long-term price movements and look for maximum potential profits to be gained from large changes in prices. So as a result, these trades generally span over a period of weeks, months, or even years, and they tend to use weekly and monthly price charts to analyze and evaluate the markets. And because of the actual longer time horizon of position trades, they will use a combination of technical indicators as well as fundamental analysis into the underlying instrument in order to identify potential entry and exit levels. So what is technical analysis actually? Technical analysis refers to financial analysis that uses patterns in market data in order to identify trends and make predictions. So it's founded on the belief that past prices are able to predict future prices. But for those of you who are aware of the study of finances or economics, you know that past performance is no guarantee of future results because of other various factors that could come in and complicate things, such as macroeconomic changes in interest rate or government policy or other various unexpected instances that we really cannot predict. So that's one of the key reasons why technical analysis is generally not very widely accepted in academia. So it tends to only be used for shorter term trades because of the fact that it doesn't take into account the longer term sustainability and operational history of the company or the instrument that you're investing in. So technical analysis is very frequently used in the first three types of trading that we discussed earlier, being scalp trading, day trading, and swing trading. Sorry, so if you actually look at the price chart here, this is an example of a candlestick chart on Bitcoin USD. So these charts actually show the closing prices and price trends. And at the bottom, you can actually see the bar graph, which is what looks like a bar graph, which is essentially the volume that is traded over the various time periods. So these charts can come in different time frames of their choice, and depending on how you read them, they can give you different insights into the market and how prices, volatility, and sentiment are for that particular trading day. So as I mentioned, this is actually a candlestick chart, and later on we'll learn what is a candlestick and how to understand these patterns in order to utilize various trading indicators. So let's now look at why we use technical analysis for cryptocurrencies. One of the key reasons for this is the lack of fundamental determinants of value. So cryptocurrencies are actually very hard to value using traditional asset pricing models that you might be able to use for equities, bonds, or derivatives. And the simple reason is because they lack a lot of fundamental characteristics. There's no underlying company whose cash flows you could analyze. And this actually results in the market becomes a very speculative one, and there is limited institutional adoption. So all these factors contribute to why we tend to use technical analysis for cryptocurrencies. Another factor is the small market capitalizations, which result in having higher volatility. And essentially, you're playing a game with the price that is driven on all these various factors like the volatility and the volumes, and you're trying to predict price movements based on these other factors. So even if it doesn't really make sense, as many crypto traders might be able to attest, it still does make money, which means that technical analysis can still be applied in certain situations to cryptocurrencies. And as a field of study, it is generally just constantly evolving so that these models are able to adapt to match the reality and not the other way around. So it's not that the markets are imitating various patterns or various charts because these patterns are known by traders, but rather over time there's a body of knowledge about how these various models can be applied to look at cryptocurrency trading. So let's dive right into the technical analysis, and what we'll be looking at first is candlestick patterns. So candlestick patterns are a method of reading price charts, and it shows you four things: the open, the high, the low, and the close price of that particular time frame. So for instance, if you're looking at a 1 minute chart, you would see a candle that shows you what price the cryptocurrency opens at, what is the high that it reaches within that 1 minute, what's the low, and then what it closes out at the end of the 1 minute before it moves on to the next candlestick. So how do you read candlesticks? A green candle means that the price closed higher on that session, and on the other hand, a red candle would mean that the price has closed lower. The two main components of a candle are actually the body and the wick. So the body actually refers to the price movement between the open and the close, and the wick looks at the maximum range that the price has moved between the open and the close. So it covers the high and the low of that time frame. So the size of the body relative to the wick can actually tell you a lot about whether buyers or sellers are in control and how strong or weak the price rejection or price support is. So depending on the time frame that you choose, which can be daily, hourly, by the minute, or even by the week, each bar represents one period of that time frame. On the left, we have a 1 hour time frame. And can you imagine how these candles would look like on a 2 hour time frame? Try to picture how the two candles would combine, taking note of the open, the high, the low, and the close. And the chart that you see on the right side is actually how a 2-hour time frame would look like after having condensed each pair of candles into one. So depending on your trading style, you would look at charts for different time frames. A swing trader who focuses on daily charts for decisions could use a weekly chart, for instance, to define a primary broader trend, and then look at the 60-minute charts to define a short-term trend before he places his position. A day trader who uses a much shorter time frame could trade off of the 15-minute charts and use, for instance, a 60-minute chart to define a primary trend. And they could even use a 5-minute chart or even a tick chart to define the short-term trend. So when you want to trade candlestick patterns, you have to consider three things, which are the trend, the area of value, and entry triggers. So you should never just trade in isolation by just looking at the candlesticks. And let me explain more about each area as we progress through the lesson. So first off, looking at the trend. One of the most popularly used trends is actually the moving average. So the moving average is an indicator that summarizes the past prices. For instance, a 5-period moving average would simply show the average price over the last 5 periods of that time frame. There are many different types of moving averages. For instance, there are simple moving averages and exponential moving averages, which use slightly different methods of calculation that would give you a different trend line. So using a moving average is actually a simple way to identify markets that are trending. And one key thing to take note of is that trading with a trend is trading along the path of least resistance, which is essentially the easiest way to do it. And you should always try to trade with the trend as opposed to trading against what the market is doing. So what are the different types of trends? So there's a strong trend. So when the price respects the 20-period moving average and the market remains below or above it all the time. There is a healthy trend, which is when the price respects the 50-period moving average. You'll notice that this is a slightly longer time frame, which means it's more lenient, which is why it's a less strong trend. So you might see a healthy pullback to the trend line, and this could be a great entry point. And finally, we also have a weak trend where we see that the prices tend to exceed the 50-period moving average. So this is where it's less reliable to look at the trend lines, and it's much more important to look at support and resistance, which we'll talk about in the next slide. So as per what I mentioned just now, you should always be looking to buy in an uptrend and looking to sell in a downtrend. So a simple rule of thumb is that if the price is above the 200-period moving average, you should try to have a long bias. And if the price is below the 200-period moving average, you should try to have a short bias. So this allows you to move with the trend rather than trying to trade against the market. So what is the area of value? It refers to areas where there could be potential buying or selling pressure. So perhaps you've heard of the term support and resistance, which is one of the most useful things to look at when you're trying to determine the area of value. So one key pointer is that you would actually never want to make your charts look like this on the top left-hand corner, where there are so many different horizontal lines. They're not wrong because they probably would indicate various support and resistance levels, but it just becomes overly complicated. So how do you actually draw out your support and resistance levels? You would firstly zoom out your charts, and then you would then proceed to draw the most obvious levels where you see the price of the asset bouncing off the various support and resistance levels. And then you proceed to adjust your level to get the highest number of touches. So what can these areas tell you? They can actually be very strongly used to identify reversals. So here you can see that this area of support has been tested a few times, the area here in gray, and the price actually holds above it. So for instance, if you are looking to enter a position, you could wait for the price to touch that area of support before longing the instrument. And based on the short-term historical trend, you would see that this area of value actually has held for the next couple of periods as well. So using the concept of area of value in totality actually can refer to a broad series of concepts. So that would be support and resistance, which refers to the lows as well as the highs that the price bounces off, respectively, the moving averages that we discussed earlier, and trend lines as well as channels. So channel is essentially a very similar concept to a combination of support and resistance, but taken on a moving scale. So when you see the support and resistance levels moving upwards, and you can see that the price of the instrument is trading within a channel, that's another opportunity for you to apply the concept of the area of value. So now we'll look a little bit more in depth at some of the entry triggers based on candlestick patterns. So entry triggers refer to signals that can tell you that it's time to enter a trade, whether it's long or short, based on whether the trigger is a bullish or a bearish one. So candlestick patterns can also be used to signal a reversal, and then in this case, they can be used as entry triggers. So the first pattern on the top left is the bullish engulfing pattern. So in this pattern, the second candle has fully covered the body of the first candle, and it essentially signifies that the buyers have taken control and reversed all the selling pressure, pushing the price even higher, where it closed above the high of the previous candle. The exact opposite of the bullish engulfing pattern is the bearish engulfing pattern, where the sellers are in control despite seeing a slight price rebound on the previous time frame. You would see a stronger price drawdown on the next one, where it closes below the lows of the previous candle. The third pattern is the hammer, which is a bullish pattern, signifying price rejection. So this is a sign of strength because essentially the selling pressure that has brought the price level down to the low of the time frame, which you can see signified by the bottom of the wick. You'll know that it's a very long wick, which is characteristic of the hammer. So having brought the price level down to that point by selling pressure, we see that the buying pressure has actually chased it all the way back up, almost to, has chased it all the way back up above the point where it opened. So it closes out into green, and this is a bullish pattern. Yeah. So there are many other patterns available. Some of the rest are displayed here, such as the shooting star, where it's essentially the exact opposite of a hammer and signifies a rejection of higher prices. So this is a bearish trigger as well. There's also the dragonfly, which functions similarly to the hammer, but the only difference is that it doesn't have a body, so there isn't a green portion as you would notice on the hammer, and it's a sign of a strength where the lower prices have been rejected and buying pressure has built back up to return the price of the instrument back to its opening price. So a gravestone doji is the exact opposite of a dragonfly and signifies a bearish movement. For the morning star, you might realize that it looks very similar to the bullish engulfing pattern. So in the first candle, we see that the sellers were in control, having brought the price down to a certain level. And the second candle shows some measure of indecision in the markets where it opens and closes at roughly the same price point. Whereas the third one finally shows now that the buyers are back in control and they have brought the price back up near the highs. So this shows a bullish reversal. The partner to this is the evening star, which is the exact opposite and functions to show a bearish reversal. Next up, we have the tweezer bottom. So this shows price rejection that has happened twice, which is a sign of strength. So we can see that sellers had been able to push the price significantly lower in the first candle, and after it opened up again, they have tried to push it lower once again and failed to do so, having brought the price, with the buyers having brought the price back up above the level that it opened in the second candle. So finally, we also have the tweezer top, which is the opposite of the tweezer bottom and signifies a bearish reversal pattern. So as I mentioned, there are actually many other more complex patterns available, such as the head and shoulders, the golden cross, all these other different patterns that use different time frames. So if you're more interested in finding out more about candlestick patterns, please do go and read up before you try to apply them. So at least you'll be able to know which scenarios and which indicators to use. So these are some examples of trading using candlestick patterns as well as the area of value. So you'll see that there's actually a support and resistance line on these charts, and there are also several candlestick patterns that were actually followed by trend continuation. So, well, just a disclaimer first, all these charts were actually cherry-picked to show winning trades because there is no guarantee that it's always going to work out in this case. So, while you look over these charts, you can think about the way that it's trending based on the price movements, the area of value like the support and resistance line, or even the moving average line. So these also all build into the entry triggers on a micro scale that you see within those 2 to 3 candles that are circled in red. So one thing to take note of is that charts can be drawn in a very, very subjective manner. They can be nonsensical, they can even be overly simplistic, because what looks like a perfectly normal chart to someone can be drawn in a different way that doesn't really make sense by, for instance, manipulating the various area of value lines that you put on, the different moving averages or the trend lines. So these can have significant differences on how the charts are presented. So beyond that, they can also be oversimplistic, and they can even be overcomplicated where there are just way too many elements going on. Yeah. Next up, we will discuss some trading indicators for you to help make your choice on whether or not to enter a position. So these trading indicators generally tend to be a combination of various other sub-factors, and they're just presented in a more digestible way that allows you to use them. So first off, we have the moving averages that we briefly touched on earlier. It's an indicator that summarizes the past prices in the instrument. So previously I mentioned that it's useful if you're following a trend following approach, where it works great as a trend filter by helping you to identify whether there are strong trends upwards or downwards. And it can also help to identify areas of value such as support and resistance. So one technique you could try to execute is actually the moving average crossover. So if you can add the 2 moving averages over 2 different periods, and when the shorter term moving average, also known as the SMA, crosses the longer term moving average to the upside, it's a buy signal. So moving average cross is a very commonly used indicator that you might hear being thrown around a lot, but this is essentially how it works. However, this means that you shouldn't always be using this especially when the market is ranging. So this means that when the prices are moving sideways and not really trending into an upwards or downwards trend, it becomes very difficult to use the moving average crossover because it would not be a conclusive indicator for a buy or a sell signal. Another entry trigger that we can look at is the average true range. So this indicator essentially measures the volatility of an instrument. So when the range of the candles get larger, the ATR increases. And how you can use this is that you can use the ATR as a stop loss. So it helps you decide on a stop loss that is not too tight, because setting one that is too narrow could result in losing potential unrealized gains. So instead of setting your stop loss right below the moving average, you can take the ATR into consideration and set a stop loss that gives your trade more room to breathe. So how you can do that is by looking at the volatility cycle as well. And when you see that the volatility is being very low, it could be a sign that something is brewing. And from here, we can see that it was signaling a breakdown where the price just started trending downwards and actually broke through the support level. So the next entry trigger is actually the stochastic indicator. So this is an oscillator that identifies momentum within the market. And it's a value that falls within the range of 0 to 100. And when the value is above 80, it is overbought, which is a signal to sell. And when the value is below 20, it's oversold, which is a signal to buy. So you may have heard this being referred to as the relative strength index in certain scenarios. So it functions in a similar fashion. So how to use this is that it can serve as an entry trigger for a trade. When you see that it has reached oversold levels, you could be looking to buy if other indicators or other entry signals add up. However, one way to not trade this indicator is going short once you see the stochastic indicator at overbought levels, or going long once you see it at oversold levels. So as I've mentioned before, I think you always have to consider the market context in its entirety and never just use one indicator or one entry signal in isolation. The last indicator that we'll look at today, definitely not the last one that is out there, but the last one that we'll look at is the Donchian channel. So we have these two, the blue bands here that you can see, which shows the 20-day high and the 20-day low. And the orange band in the middle shows the average of these two blue bands. So how do you trade this is that you can actually use it as an entry trigger by waiting for the candle to touch the upper blue band, which means it has broken above the 20-day high. It is a sign to go long. So always also bear in mind that you would have to use a trend filter on this. So just like moving averages, the Donchian channel can perform something similar. If the price is above the middle orange band, it could suggest an upward trend, and you can look out for long opportunities, and vice versa for the price being below the orange band and looking for short opportunities. However, do take note that one way that you should definitely not be trading this indicator is by treating the blue bands as support or resistance levels, because that goes quite fundamentally against what the indicator itself actually displays. So you might be wondering how you can actually combine these indicators. After having learned several of these trading indicators, you can take your trading even further by learning how to combine them in order to make a more informed trading decision. But you don't simply just combine any indicators. It's important to know beforehand what the indicators do and make sure that these two indicators don't come from the same category. So for instance, the stochastic indicator is an oscillator, and there's also something called an RSI indicator, which we touched on a little bit just now. It's also an oscillator. So you shouldn't be needing two indicators that do the same thing. So how do you actually combine it? Is you can combine firstly a moving average plus a stochastic indicator, as we can see on the second image here. So the moving average acts as the trend filter, and from here you know whether you want to go long or short, but you're just looking for the entry opportunity. You already know what you want to do, but you're looking for the when. So the stochastic indicator can help to identify these areas of value, and you can look out for oversold areas before you can long this instrument. Another potential combination that we display here is the Donchian channel plus the average true range. So using the channel as an entry trigger, we can see that here that the green candle touching the upper blue band means it's at a 20-day high. So the ATR can also then help to identify possible breakouts when the volatility has been on a multi-year low. So using both indicators together, you get a great entry trigger here. And the Donchian channel can also very interestingly be used to set your trailing stop loss. So the main takeaways from this lesson on trading is that you need to know what indicators you're using and how they work. And secondly, know when to use these indicators, especially if you're trying to use them in isolation or in conjunction with other indicators. And last but not least, know when to use which different indicator and how to combine it as well, so that you can get the best of both worlds and not have overlapping and non-significant sources of information that basically don't add much to your trading decision. And as always, always remember to consider the context of the market. Yeah. So we'll also discuss a little bit of risk management before we wrap up. So risk management is one of the most important concepts for a trader to understand. And without proper risk management, you can easily blow out your account and you can lose all the gains that you've realized even. Yeah. So one key concept under risk management is your position sizing, which takes into account how much you want to risk per trade. So you should be considering how much capital you have, and then decide how much you want to risk per trade, which is usually about 1 to 2%. If you are a beginner, you can stick to this number, but perhaps if you're more advanced and familiar with trading, you may want to increase your position size in order to capture a maximum upside. So then you should also decide on the stop loss level using the moving average or the true range. You could also look at your position size will also determine the amount that you want to risk or your stop loss level. So this is essentially the value that you have at risk. For example, so if my account has $100,000, this means I would risk $1,000 per trade, which is 1% of my capital. And if I were to set my stop loss at $50, my position size would be 20. So the tighter your stop loss, the larger your position size can be. But keep in mind not to make your stop loss too tight, as you might easily get stopped out by minor fluctuations in the market. So the next concept under risk management is setting a stop loss. As we've mentioned quite a lot just now, you have heard the term stop loss a few times, but what exactly does it mean? You can see it as an order that is made, that is placed in advance but not fulfilled, that allows you to close out your position if it hits a certain price level. So for example, if I buy one Bitcoin at 38,000 and Bitcoin drops to 37,000, if I have a stop loss at 37,000, this means that I will automatically sell it to reduce my losses in case the price falls lower. As a sister to a stop loss, there is actually also a trailing stop loss. So this means that rather than setting a specific price that you want to close your position at, you can set a maximum or minimum value or a percentage of the loss that you would want to incur before your position gets closed out. So in terms of determining how much to set your trailing stop loss at, this is where using the MA or the ATR comes in very handy. The trailing stop loss is also very useful if you're trying to capture as much potential upside as you can. You're essentially chasing the price movement up, but lagging behind by a predetermined percentage or a predetermined dollar value. So this allows you to maintain some measure of risk management while also capturing large upsides that could occur. The third point is always trade with a plan. So don't ever trade blindly, and do come up with a trading strategy. So try your hand in the market, come up with rules based on your risk profile, your risk management, how much you're able to stomach, and test them out and then see whether they work for you. So someone else's plan may not be able to work for a different individual. So always do come up with your own plan. And the final point under risk management is to trade based on structure and not emotion. So you should essentially identify a pattern that you are confident in executing and stick to it. And when that pattern breaks, you should immediately tell yourself to get out of that position, no matter if you make a profit or a loss. So this is actually one of the reasons why algorithmic trading is actually very much on the rise, because computers are able to trade purely based on structure rather than the emotion that a trader would experience. You know, for instance, if they have been in the red all day and they suddenly take a large position size on in order to try and recoup their losses, and this could lead to further their losses further worsening. Or for instance, if you've been on a winning streak all day and you've made a significant amount of gains, and if the pattern that you are using breaks and you just try to cycle yourself into thinking that, oh, I've been winning for so long, perhaps this one will come out a winner as well, and you don't set a stop loss or you don't get out of the position, and this will just eat into your gains over time. So now that we've discussed how to trade and how to manage your risk, let's finally look at where to trade. So there are many platforms available for you to trade crypto, and to know what works best, you should consider several factors. The first being the coins that are offered, secondly being the fees, thirdly the security, as well as the liquidity. So in terms of the coins offered, depends on which cryptocurrency you would want to trade. And not every exchange offers each of the thousands of cryptocurrencies that exist out there. So do always go in knowing which coins you would like to trade. I'll also always be aware of the fees, if there are any hidden fees. For instance, if there's certain cases where fees can vary based on price volatility, although they are usually charged per transaction. So, but the lesson is just to always understand what you're paying for before you go into using this platform. The third factor is the security. So remember that crypto is not actually backed by any central institutions, although it is being increasingly adopted, as we will learn in the fourth video. So do remember that your crypto holdings are not protected the same way as your money in the bank. So there isn't FDIC or SDIC that comes into play if the exchanges are hacked or compromised. Some exchanges do have insurance policies. For instance, Coinbase, and it has an insurance policy worth about $255 million. So the security concerns are definitely something you need to look at. Finally, in terms of liquidity, the exchange that you choose should have enough trading volume where you can buy and sell your crypto easily. So the more popular exchanges would generally tend to have a larger trading volume, and this narrows the bid and ask spread, allowing you to sell your crypto easily instead of having to consistently be lowering your prices in order to incentivize other buyers to buy from you. So finally, we have listed out some resources for further research. So if you're interested in trading, you should definitely be checking these out. What I've shared is just a brief introduction, and it's by no means the most comprehensive guide, because there are so many different indicators and instruments out there, even in the cryptocurrency market. So what you should do is start off with a practice demo account first, and don't directly dive into the market right away. And secondly, always just trade with money that you can afford to lose. So just have an idea of your finances and how you would need to allocate them. And despite what everyone on Wall Street bets says, please do not gamble your life savings when you're trading crypto, unless you're extremely, extremely confident that you're going to make a good return on it. Yep. So essentially, all these resources are just available here for your learning. So do go and check them out if you're more interested in looking at the various platforms or learning in depth how to trade as well. So this brings us to the end of the third video on trading as well as altcoins. Do go and brush up on the slides if you want to revise everything that we have covered. And remember everything we've mentioned in risk management as well. But always just remember to have fun ultimately. Yep. So this brings us to the end of the third video, and I will see you again in the fourth video for lesson 3. Thanks.